Current market data shows Walmart Inc., ticker symbol WMT, trading live at $107.03, up a staggering $6.39, or roughly 6.38% on the day. If you are looking at your screen right now, you are seeing a massive green candle that has completely engulfed the trading range of the last few weeks, shattering resistance levels that traders have been watching for months. This isn't just a standard earnings pop. This is a fundamental repricing of the world's largest retailer. The stock opened strong at $103.94, dipped briefly to $102.68, and has been on a relentless tear upward, smashing through the $107 mark as volume pours in from every corner of Wall Street. You probably expected a decent quarter. The narrative going into this morning was that the consumer is stretched, inflation is sticky, and maybe, just maybe, Walmart would squeeze out a small beat on grocery sales because people have to eat. That was the expectation, a safe, boring, defensive play for a volatile 2025 market. The reality, however, has just blown the doors off that thesis. Walmart isn't just surviving the economic pressure, it is weaponizing it. What we are seeing today is the market waking up to the fact that Walmart is no longer just a brick-and-mortar grocery store. It is rapidly transforming into a high-margin technology and advertising juggernaut that deserves a valuation multiple closer to Apple stock or Nvidia stock than it does to a traditional supermarket. Let's talk about the elephant in the room, or rather the massive news that dropped alongside the earnings. Walmart is leaving the New York Stock Exchange. You heard that right. The company that has been a staple of the NYSE for decades is packing its bags and moving its listing to the Nasdaq, effective December 9th. This is not just a cosmetic change of venue. This is a calculated signal to the algorithmic traders and the Schwab intelligent portfolios of the world that Walmart views itself as a modern, tech-enabled growth company. By aligning with the Nasdaq, they are positioning the stock alongside the likes of Microsoft and Alphabet, psychologically shifting how retail investors on Robinhood stock trading apps and institutional managers at Fidelity Investments perceive the company's future growth trajectory. It's a branding move for the stock itself, and the market is absolutely loving it today. But the Nasdaq news is just the cherry on top. The core engine driving this price action is the Q3 fiscal year 2026 earnings report that just hit the tape. Revenue came in at $179.5 billion, up 5.8% year over year. That is a massive number, beating analyst estimates by over $1 billion. But if you look closer, the quality of that revenue is what matters. Global e-commerce sales soared 27%. Think about that for a second. In a world where Amazon is supposed to be the undisputed king, Walmart is growing its online business at a pace that is making Silicon Valley blush. They are winning the convenience war, and they are doing it while maintaining their dominance in physical retail. The real story, the one that has the smart money accumulating shares on interactive brokers trading platforms right now, is the explosion in high-margin revenue streams. We are talking about Walmart Connect, their advertising business. Ad revenue grew 28% globally and 33% in the US alone. Why does this matter? Because selling a gallon of milk has a profit margin of pennies. Selling a digital ad on a checkout screen or a sponsored search result on Walmart.com has margins that look more like software. As this business scales, it drags the company's overall profitability higher, which is why you are seeing the stock price react so violently. Investors are realizing that the Walmart of 2030 will be a media and logistics company that just happens to sell groceries. Now pause for a second. I want to know where you stand on this shift. Do you think Walmart moving to the Nasdaq is a genius rebranding move, or is it just window dressing for a legacy retailer? Comment below with Team NYSE or Team Nasdaq and tell me if this changes how you view the stock. Let's get back to the chart because the technicals today are screaming a breakout. For the last 3 months, WMT had been consolidating in a tight range between $98 and $102. Traders using SoFi active investing tools were likely getting frustrated with the lack of movement, seeing capital rotate into faster-moving sectors. But that consolidation was actually accumulation. The smart money, the institutional whales, were quietly buying up shares while the retail crowd was distracted by shinier objects. Today's gap up above $103 confirmed a massive breakout pattern. We have cleared the 52-week highs, and we are now in price discovery mode. When a stock hits all-time highs on this kind of volume, over 18 million shares traded before lunch, it often signals the start of a new leg higher, not the end of a move. There is another major piece of news fueling this rally that we have to discuss: the leadership transition. Doug McMillon, the CEO who steered Walmart through the pandemic and the digital transformation, is retiring. In almost any other scenario, a CEO departure causes uncertainty and a stock drop. But today, WMT is up 6%. Why? Because the successor is John Furner, the current head of Walmart US. The market knows John. He has been the architect of the store renovations, the supply chain automation, and the push into omnichannel retail. They view him as a safe pair of hands who will continue the strategy without missing a beat. This is a textbook example of a well-executed succession plan, and it gives long-term holders in Fidelity Wealth Management accounts the confidence to stay the course. When you compare this to the broader retail landscape, the divergence is striking. Look at Target. Look at Dollar General. They are struggling with shrink, with fluctuating consumer demand, and with supply chain headaches. Walmart, on the other hand, is flexing its scale. They have the leverage to negotiate lower prices from suppliers, and they are passing those savings to customers to drive traffic. We are seeing a trade-down effect, where even households making over $100,000 a year are doing their grocery shopping at Walmart to hedge against the cost of living. This demographic shift is sticky. Once a high-income shopper realizes they can get the same brands for 15% less and pick it up curbside in 10 minutes, they don't go back. Walmart is capturing market share from premium grocers, and that is a terrifying prospect for the competition. Let's look at the macro picture for a moment. We are heading into the holiday season, the most critical time of the year for retail. Walmart just raised its guidance for fiscal year 2026. They are now expecting net sales to grow between 4.8% and 5.1%. Raising guidance into a holiday quarter is a massive flex. It tells us that their internal data, which is arguably better than any government economic report, shows that the consumer is ready to spend, provided the value proposition is right. While other retailers are issuing cautious warnings, Walmart is effectively saying, "We are ready, bring it on." If you are a self-directed investor using Robinhood fractional shares or managing your own IRA on a SoFi trading platform, you need to understand the defensive nature of this breakout. Usually when a stock spikes 6%, it's a high-beta tech name or a biotech company. For a mega-cap consumer staple to move like this implies a massive rotation of capital. Fund managers are likely dumping riskier assets and parking cash in Walmart because it offers both growth from e-commerce and ads and safety from grocery dominance. It's the rare all-weather stock that works in a recession and works in a boom. Technically, we need to watch how the stock closes today. If Walmart can hold above the $106 level, it sets a new floor. The next psychological target is $110, and then analysts will likely start revising their price targets toward $120 or even $130 as they factor in the higher margin profile from the ad business. However, be careful of the FOMO trade. If you are chasing it right here at $107, you are buying extended. A pullback to retest the breakout level at $103 or $104 would be perfectly normal and could offer a better entry point for those who missed the morning bell. It is also worth noting the options activity. We are seeing a spike in call buying for the December and January expirations. This suggests that traders are betting on this momentum carrying through the holiday season. If you look at the option chains on your Interactive Brokers account, you'll see significant open interest building at the $110 strike. This creates a potential gamma squeeze effect where market makers forcing to hedge their positions end up buying more stock, pushing the price even higher. It's a positive feedback loop that could keep WMT elevated for weeks. We should also touch on the fintech aspect of Walmart. Yes, they are a retailer, but with their majority stake in PhonePe in India and their growing financial services in the US, they are quietly building a financial ecosystem. It's not unlike what SoFi is doing, but attached to the world's largest physical retail footprint. They are reducing credit card transaction fees by pushing their own payment solutions and Walmart Pay. Every fraction of a percentage point they save on transaction fees adds millions to the bottom line. It's this operational discipline, finding pennies in the couch cushions on a scale of billions of dollars, that makes Walmart such a formidable machine. Let's briefly discuss the risks, because no investment is without them. The primary risk here is execution on the automation front. Walmart is spending billions to automate its supply chain with high-tech fulfillment centers. If this rollout hits snags or doesn't deliver the promised efficiency gains, that margin expansion story could stall. Additionally, the valuation is getting richer. At these levels, Walmart is trading at a forward PE ratio that is historically high for a retailer. The